You spent 30 years paying for a country that was quietly getting worse, every one of them. And the day you finally decide to leave, Canada sends you one last bill. It is called the departure tax, and it lands on money you have never actually touched. For decades, the deal in Canada was simple and almost fair. You paid some of the highest taxes in the developed world. In Ontario, the top rate reaches 53.5%. In return, you got safe cities, universal health care, and a stable life. That was the trade. High cost, high quality. Then the second half of the bargain quietly stopped showing up. Wait times stretched, housing detached from income, the roads aged, productivity growth slipped to among the weakest in the G20. A family doctor can now be a multi-year wait. The taxes stayed, the services thinned. The deal expired without anyone announcing it. Here's how leaving actually works. There is no exit gate, no fee at the airport. It is a single line on your final Canadian tax return. But severing ties is not just buying a plane ticket. It means selling the home, moving the family, cutting residential ties. While you live in Canada, it taxes your worldwide income. The moment you stop being a tax resident, one rule activates. It is called deemed disposition. On the day you leave, the government pretends you sold everything. Your stocks, your crypto, your private company shares, your foreign property. You did not sell a thing. It treats them as sold anyway, at full market value the day you go. Whatever those assets gained while you lived there becomes taxable. Half of that gain is added to your income that year. The inclusion rate is 50%, confirmed after the 2025 reversal. Then it is taxed at your marginal rate. And the Canadian income you leave behind faces a 25% withholding. A few things are exempt. Canadian real estate, your RRSP, your TFSA. Everything else, the assets that actually grew, is fair game. Picture being taxed on your home's gain the day you move out, keys still in hand. So here's what that bill looks like for a real person. You built a company over 15 years and invested alongside it. On paper, your shares and portfolio have gained $4 million. You never sold a share, not one. The day you leave, half of that gain becomes taxable income. $2 million taxed at Ontario's top rate. The gain is measured from the day you first bought in. Decades of quiet growth, taxed in a single year. The departure tax comes to about $1,070,000 on money you never cashed out. And you are not the only one packing a suitcase. In 2024, a record 106,000 Canadians emigrated, the most in a decade. Net departures hit the highest level in the 50-year record. Exit tax filings tell the same story. Roughly 1,000 in the past decade, against about a dozen in the 20 years before that. So who does this actually fall on? Not the average worker leaving for a job in Texas. Their gains are small. The tax barely registers. It falls on the people whose assets grew. Founders, investors, anyone holding stock, crypto, or private shares that appreciated. The exact people a country most wants to keep. 2/3 of the Canadians leaving are aged 20 to 44. Prime earning years, prime building years, and the wealthy increasingly leave for good. Canada's net inflow of millionaires fell to about 1,000, the lowest figure ever recorded. One wealth report dropped Canada from 4th to 9th among destinations. Here is the catch. Two of them, actually. The first is mechanical. You do not have to pay the bill in cash that day. Canada lets you defer it. You post security with the tax agency and leave without paying upfront. Deferral is a tab left open, not a bill torn up. The bill follows you, and arranging it takes months, sometimes years. Done without planning, it becomes a problem that is hard to undo. The second catch is about scale, and it is honest. The headlines say everyone is fleeing. That is not quite true. Worldwide, about 140,000 millionaires moved last year. That is roughly 0.2% of them. A meaningful trickle of the most mobile, not a stampede. And leaving is rarely as clean as the headlines suggest. Many who plan the move never actually take off. And Canada still attracts new wealth. It has not collapsed. The honest frame is not that Canada is over. It is that the premium you paid for quietly evaporated. None of this is advice. Rules and rates change with every budget. What is true today can be rewritten in a single announcement. So here's the verdict on the departure tax. If you rent, save inside registered accounts, and hold a few gains, leaving costs you almost nothing. If you built something, a company, a portfolio, a position, the exit is expensive, and the math rewards leaving earlier rather than later. The longer you stay, the more the gain grows, the bigger the bill. This is not a reason to leave or to stay. Canada does not lock the door. It prices the exit. The door stays open, the toll is just printed on the way out. And it prices it highest for the people it can least afford to lose. Tonight, open your brokerage statement and read the unrealized gain at the bottom. That number is what the exit would be measured against. One shift changes everything.